What's going on, everybody, and welcome back to another episode of the Trade for Yourself podcast, where my mission here is very simple. I just want to help you learn how to trade and invest in the stock market for yourself. So make sure you please subscribe. Make sure you listen to this episode from start to finish. I promise you, you will not regret it. Please note anything discussed in this episode is not financial advice, so please do your own research before investing into any stock. Please note Webull. Webull is going to give you up to 12 free stocks valued at up to $3,000. There's only 3 things I need you to do. Number 1, click the link in the description of this video. Number 2, open you up a Webull brokerage account. Number 3, deposit any amount of money in that brokerage account, and Webull is going to give you up to 12 free stocks valued at up to $3,000. Look, if you want to have some money to start your portfolio up, please click the link in the description of this video and get you some free money to start your portfolio. In this particular episode, we're going to talk about the Vanguard Information Technology ETF, ticker symbol VGT, versus the Invesco QQQ ETF, ticker symbol QQQ. We're going to look at the differences of this ETF, and we're going to see which ETF rises to the top and which one is the best for your portfolio. Let's get into it. Okay, everybody. So I want to start this comparison off with the Vanguard Fund. And so this is the Vanguard Information Technology ETF, ticker symbol VGT. Okay, this is the ticker symbol VGT ETF. Now, what's very, very important is to understand that this is an index fund, but it only tracks technology companies. Only companies that are classified as technology companies according to the S&P 500. That will be very, very important later as we go throughout this video. Now, a couple of key things I just want to look at in this overview: an expense ratio of 0.10. That's really not that much, y'all. I'm really not tripping on that at all. And an SEC yield of 0.67. Now, this is not a dividend yield, but what I would call it is an approximation of the dividend yield. And so you could take that as an approximation of the dividend yield, because this particular ETF does put out quarterly distributions, which is very, very good to take into consideration. Now, if we look at the top 10 holdings, let's check it out. We have Apple, we have Microsoft, we have Nvidia. That's your top 3. We have Broadcom, a semiconductor company, Salesforce. You have Cisco Systems, Accenture, Adobe, Advanced Micro Devices, and Oracle. So we have a mix of software companies, pure IT plays, semiconductor companies, cybersecurity, the whole 9 yards, right, in terms of what's in the top 10. But what I want us to understand very, very closely is the top 2 companies. 21.67% of this ETF is Apple. 21.10% is Microsoft. So over 42% of this fund is housed in 2 specific companies. If you add in Nvidia and you add in Broadcom, over 50% of the fund is 4 companies. So this is very, very important to understand, right? This is very, very important to understand. The top 10, is pretty much housed with all technology companies, but Apple and Microsoft are heavy, heavy hitters. And here's the thing, a lot of people like that. You like to have Apple and you like to have Microsoft being your top 2, and then everybody else falling under that. But that's something that you have to take into consideration when you're looking at this particular ETF. But at the same time, just keep this in mind, you still have every single technology company that is in the S&P 500 housed in this ETF. So let's look at the performance. And I know that this is the main reason why you even clicked on this video, is because you care about the performance. So I really only want to focus on the 5-year performance and the 10-year performance, because on the Trade for Yourself podcast, we care about the long term. The long term has to be the fundamental when you are talking about investing in the stock market. Now, if we look at the market price for this particular ETF, the 5-year average performance is 20.68%, which is very, very good. 20.68% is very, very good. The 10-year performance is 20.95%, which is very, very good, okay? Since inception, when this fund was started, the fund has been giving on average of 12.78%, which gives a very, very broad range because we understand that the last 5 to 10 years, technology has been rewarded very, very significantly. I believe that technology will continue to be rewarded, but it's important to understand, just to give a little bit of perspective, what has it done since inception? And year to date, what has it been doing year to date? 39.03%. Outstanding. So what I'm going to tell you is this particular ETF, even though we have heavy allocation towards Apple, even though we have heavy allocation towards Microsoft, I believe that's the reason why this ETF is so high, because we have the highest allocation towards the best companies. And that's what I love. I love when we are giving the money to the heavy hitters, because that allows you to perform. When you look at the Los Angeles Lakers, they're giving the heavy money to LeBron James. They're giving the heavy money to Anthony Davis. That's what you got to look at, right? When you look at the Golden State Warriors, they're giving the heavy money to Stephen Curry. They're giving the money to Klay Thompson. They're giving the money to Draymond Green, right? You want to have your heavy hitters at the top of the list. And so when you look at this performance, it's solid. There's nothing bad that I can tell you about the Vanguard Information Technology ETF. So let's go over to the QQQ ETF and let's see what the differences are. So if we look at QQQ, a few things kind of point out to me. If we look at the total expense ratio, we've got 0.2%, which is higher than the 0.1% that you have with the VGT ETF. The number of holdings, 101 holdings. Now that's very, very important, because this particular ETF does not house just strictly technology. You have other sectors in the stock market that are housed in this particular ETF, which could be very, very important to you when you break everything down and you put everything into consideration. We don't have the SEC yield on here, but I'll go ahead and tell you the 30-day SEC yield is 0.63%, which is lower than the Vanguard ETF. So the Vanguard has a better expense ratio and has a better SEC yield. So that's something that I want you to understand when you look at just the fund details and the overview of this particular ETF. Now, here are the top 10 holdings. Now look at the key differences. Notice these differences: Microsoft, Apple, Nvidia, Amazon, Tesla, Meta, 2 shares of Google, Alphabet, Broadcom, and Pepsi. So this is what you got to understand, right? Again, this is not pure technology. This is not pure technology. But number one, Microsoft and Apple are not as heavy. In Vanguard, in VGT, Microsoft was 21%. Apple was a little bit more than 21%. Now Microsoft is 12.89%. Apple is 12.45%. Nvidia has a higher allocation in this particular ETF, but we didn't have Amazon. We didn't have Tesla. We didn't have Meta. We didn't have Google. And we didn't have Pepsi. We still have Broadcom here in the top 10, but we didn't have Pepsi. And so what you have to understand is that in this particular ETF, you're going to get diversification from most of the different sectors except for energy. Energy is pretty much the only sector that you're not going to get any, diversification from. But you have to look at the differences. In VGT, you're going to have strict technology, but understand this. Tell me that Amazon is not a tech company. Tell me Tesla is not a tech company. Tell me Meta is not a tech company. Tell me Google is not a tech company. Netflix is in this ETF as well. Tell me that Netflix is not a technology company. So those are the things that you're going to be giving up when we're talking about investing strictly into QQQ. So let's take a look at the performance, and the performance is going to tell us a lot about this ETF. So let's just focus on the market price, okay? The 5-year performance was 17.39%, which is not as good as Vanguard. The 10-year performance, 18.96%, which is not as good as Vanguard. Since inception, 9.17%, which is not as good as Vanguard. And year to date, the ETF is up 39.14%, which is slightly, ever so slightly more than Vanguard. Now, understand this, y'all. This is what I want to tell you. VGT has a better historical performance than QQQ. But we have to take this into consideration. Take it into consideration that we're talking about just pure play technology, right? Just pure play technology is what we're talking about. But in this particular ETF, we have so many other companies involved here. So when you look at the sector allocations in QQQ, you've got 58.75% technology, but you've got 19.11% consumer discretionary. You've got 6.24% healthcare. You got 4.81% industrials. You got 4.6% telecommunications. You got 4% consumer staples. You got 1% utilities. You got a little bit of energy. You got a little bit of materials, and you got a little bit of real estate. So this particular ETF houses multiple sectors. So I think that kind of boils to why you see that QQQ doesn't have the same 5-year and the same 10-year performance that the Vanguard ETF does. But at the same time, you have to take into consideration, if you want to pick VGT, do you want to put yourself away from Tesla? Do you want to put yourself away from Amazon? Do you want to put yourself away from Meta and Google? And what I mean by that is you won't have that direct exposure. And what I mean by that is concentrated exposure. You can get exposure to all of those stocks in VTI, but you won't have that concentrated exposure to it. So that's why you have to, that's why it's really that tug and pull when we look at VGT and we look at QQQ. Which one are we going to hold on to when we look at it and we say, hey, I want to have exposure to a breadth of companies, or do I just want to have just direct exposure to tech? That's really that's really what you have to decide when you say, hey, which one is better, VGT or QQQ? So based on everything that we've gone over, VGT is a better ETF than QQQ. But there's 3 reasons why I believe that you should not completely dismiss QQQ, and you should consider these things before making a decision on which ETF you're going to buy. Number 1, think about the holdings in QQQ versus VGT. VGT is strictly technology, which, don't get me wrong, is great technology, but it's strictly technology. If you decide to go with just only VGT, you're going to miss out on holding Tesla, Meta, Amazon, and Google in a concentrated way. You can own those stocks in VTI and the S&P 500, but it's not going to be in a concentrated way. You may have 2% here or 1% here, right? You'll own these particular stocks in a concentrated way, and that will give you the exposure to the best stocks in all of the industries, not just technology. Number 2, VGT may be the best performing ETF, but QQQ is the most popular ETF. How can that help you out? QQQ can actually help you provide income. So if you decide to let QQQ be your long-term index fund, over a 10-year time span, you dollar cost averaging into it, if you have 100 shares or 200 shares or 500 shares, that may give you an opportunity to sell covered calls for income in the next bear market, next bull market, or whatever market we are in. So QQQ is the most popular ETF, so trading QQQ and selling covered calls on QQQ is going to be a lot more lucrative than VGT, just because of the sheer number of shares that are traded in QQQ versus VGT. And number 3, past performance is not always an indication of future performance. Let me explain. Tesla full disclosure, is my number one position in my portfolio. I am thoroughly bullish in Tesla. What if Tesla is the number one position in QQQ in 10 years? What if Tesla is the number one position in the S&P 500? What if Google is the number 3 position? What if where the current stocks and the current holders in QQQ are shifted a little bit and Tesla has a higher weighting, or other stocks in other sectors or other smaller stocks in other sectors become a bigger weighting in QQQ? I believe that is then going to shift the performance in QQQ versus VGT. Don't get me wrong, Apple is a GOAT. Microsoft is a GOAT. All of the companies in VGT are great companies. But if we start playing around with the weightings and we start looking at other stocks in QQQ becoming higher weightings in the index, over the next 10 years, QQQ may actually have a better performance than VGT. So it may be a better situation to not just thoroughly dismiss QQQ, but it may be a better situation to maybe go with a split approach. Maybe go half VGT and go half QQQ. That way, if you're a pure technologist, you can have your VGT fix. And if you're a QQQ individual, you can have your QQQ, and you can be able to grow that and be able to have that optionality from potential income potential down the road. As always, I appreciate you all for tapping into another episode of the Trade for Yourself podcast. Please like, please subscribe. Let me know what ETF you think is better, right? This was an opportunity for me to lay out everything on the table and do a fair comparison between VGT and QQQ. Do you want to pick one or the other? Do you want to just own VGT and VTI? Do you want to just own VTI and QQQ? Let me know what you think about these particular ETFs and how they will be used in your particular portfolio. As always, remember, y'all, don't pay for it. Trade for it. I'm going to tap in with y'all next episode.